Stop looking at the price ticker on your screen. It is a hallucination. What you are seeing, that digital number flickering in red and green, is no longer a reflection of reality. It is a ghost. At this exact moment, a fracture is tearing through the bedrock of the global financial system, and almost everyone is too distracted to notice. We are not approaching a simple market rally. We are staring down the barrel of a systemic liquidity crisis, where the promises of paper wealth are about to collide with the unforgiving laws of physics. The figure of $110 per ounce is not a fantasy. It is the mathematical inevitability of a market that has run out of metal. To understand the gravity of what is unfolding over the next 72 hours, you must first unlearn everything you have been told about market efficiency. The spot price is a lie. It is a derivative construct, a shadow cast by a system that leverages paper contracts 400 to 1 against the physical asset. But shadows cannot build solar panels, shadows cannot conduct electricity in a Tomahawk missile, and shadows cannot protect wealth when the currency itself begins to dissolve. We are witnessing the death of the paper-silver experiment. The stampede has begun, not into the market, but away from the ledger. The most terrifying signal right now is not the price volatility. It is the silence of the vaults. We have entered a state of extreme backwardation. In a healthy, functional economy, a commodity should cost more in the future than it does today, accounting for storage, insurance, and interest. That is the natural order. But today, that logic has been inverted. The desperate hunger for immediate physical delivery has driven the spot price higher than the futures price. This is the market screaming that there is a shortage. It is the sound of industrial giants realizing that if they do not secure the metal now, it may not be there tomorrow. For decades, this market was governed by a comfortable illusion. Bullion banks would short the metal, flooding the digital exchanges with paper, promises to keep the price suppressed. It was a game of musical chairs, played with billions of dollars, built on the arrogant assumption that the music would never stop. But look closely at the positioning of the titans. The very institutions that spent years pressing the boot onto the neck of the silver price giants like JP Morgan and HSBC are no longer fighting the tide. They have flipped. Internal data suggests a massive, covert accumulation. They are moving from net short to aggressively long. When the hunters become the hoarders, you know the ecosystem is collapsing. The shift is not speculative. It is survival. The liquidity in the silver market is evaporating, creating air pockets where the price swings violently by 5 or 7% in minutes. This is not normal trading behavior. This is the turbulence of a $5 trillion market realizing it is hollow. The paper market is becoming a ghost town, while the physical market is turning into a fortress. While the screen tells you one price, try to acquire a 1,000-ounce bar for immediate delivery. You will find the premiums are 30, sometimes 40% higher. That premium is the real price. Everything else is fiction. We must contextualize this against the backdrop of history to see the magnitude of the threat. In 1980, the Hunt brothers attempted to corner the silver market. They were two individuals fighting the combined might of the Western regulatory apparatus. The government changed the rules, raised margin requirements, and crushed them. But the squeeze we are watching today is not driven by two cowboys in Texas. It is being driven by sovereign states. It is being driven by the BRICS alliance. You cannot margin call a nuclear power. You cannot change the rules on a country that holds the physical mines. This is the ghost of 1980, but scaled to a planetary level, and this time the exit doors are welded shut. The axis of financial power is rotating from the west to the east. While New York and London trade paper contracts, Shanghai trades physical metal. For years, the Shanghai Gold Exchange has traded at a consistent premium over the West. This was the silent alarm. China and India have been draining the global vaults, exchanging their surplus dollars for atomic weight. They understand that you cannot build the next century's infrastructure on debt. They are preparing for a world where the dollar is no longer the undisputed king of trade. And in that world, he who holds the gold and silver makes the rules. But beyond the geopolitical chess game, there's a structural choke point that no amount of monetary policy can fix. Silver is not just money, it is the most conductive element on the periodic table. It is the nervous system of the modern world. We are in the midst of an artificial intelligence revolution that is voracious. Every new data center, every GPU cluster, every high-performance circuit board requires silver. The demand from the electronics sector is projected to rise by 8% this year alone, and that is a conservative estimate. Consider the energy transition. The solar industry is on track to install record capacity this year, consuming over 125 million ounces of silver annually. We are approaching a scenario where the solar industry alone could swallow 20% of the total annual supply. And unlike gold, which sits in a vault forever, the silver used in industry is often consumed. It is pasted onto silicon wafers, buried in landfills, or vaporized in chemical processes. It is gone. We are burning the candle at both ends, draining the vaults, while simultaneously destroying the supply. There is a darker layer to this demand that is rarely discussed in polite company, the military-industrial complex. We are living in an era of escalating kinetic conflict. Modern warfare is high-tech warfare. Silver is a non-negotiable component in the guidance systems of cruise missiles, in the optics of fighter jets, and in the sensors of hypersonic projectiles. When a missile strikes its target, that silver is vaporized in a flash of heat. It is removed from the periodic table of available assets forever. As global defense budgets swell to record highs, the strategic scramble for high-purity silver is intensifying. This is not just about profit, it is about national security. The physical evidence of this shortage is already manifesting at the retail level. Mints across North America are reporting delays and shortages, but the real panic is happening upstream. We are seeing industrial scrambling. This occurs when manufacturers, the people making electric vehicles and solar panels, bypass the COMEX entirely. They are going directly to the mines, securing supply at the source, leaving nothing for the public markets. When the big players exit the exchange, liquidity dies. The buffer is gone. We are now looking at a structural deficit for the 5th consecutive year. Mining output is flat. The easy silver has been found. The grades are declining. And yet, the demand is parabolic. This is the definition of a squeeze. It is not a matter of if the price will reset, but when. And the when may be dictated by the events of the next 72 hours. The financial world is fixated on the Federal Reserve. They are waiting for a statement, a rate decision, a signal. But do not be distracted by the theater of central banking. The real event is the collapse of confidence. We are entering a liquidity trap where traditional tools no longer work. If we see a crack in the bond market or a sudden spike in yields, the flight from paper assets will be instantaneous. In a crisis of confidence, capital does not walk to the exit, it runs. And the exit door into physical precious metals is incredibly narrow. There are 3 scenarios to watch. First, the confidence shock. If the central bank's control is questioned, the dollar index could break critical support levels, sending gold and silver into a parabolic discovery phase where prices jump 10 to 20% overnight. Second, the tariff escalation. Trade wars and tariffs on critical minerals would effectively double the cost of industrial inputs, creating an inflationary shock that silver would price in immediately. And third, the margin flush. The exchanges may attempt one last desperate move to save the shorts by raising margin requirements, forcing retail traders to liquidate. This is why leverage is a trap. If you are trading this market with borrowed money, you are a target. The house controls the casino, and they will shake the table before they let the payout occur. The only winning move is to remove the counterparty risk, to hold the asset that has no liability attached to it. The divergence between the paper price and the physical cost is the signal that the system is breaking. If the price drops but the premiums stay high, it is a gift. It is a final opportunity to exchange failing currency for real value. The transfer of wealth we are approaching will be the largest in history. It will not flow to the day traders or the algorithm writers. It will flow to the patient. It will flow to those who understood the difference between price and value. The era of cheap, suppressed silver is over. The era of resource-backed reality has begun. The next few days are critical. Watch the flows, ignore the noise, and trust the weight of the metal. The fracture is open. The stampede is underway. Make sure you are standing on the right side of history.